Welcome back, everyone, to Money and Markets. We have discussed how stocks, bonds, and currencies performed in 2010 and offered several ways to play them in 2011. But in order to really understand the markets, it helps to know how they interact with one another. So to cap our review of the U.S. markets, we're bringing back all of our guests. Mike Larson, interest rate and financial specialist, Weiss Research, and the editor of the Safe Money Report, is back on set with us. And on Skype, we have Bryan Rich, the editor of the World Currency Trader, and Nilus Mattive, editor of the Income Superstars newsletter. Gentlemen, thank you all so much for being here. Mike, I want to start with you. Nilus told us a little earlier in the show he sees another positive year ahead for the stock market. What's your take for stocks moving ahead in 2011?
Sure. Well, I think we're going to have a real divergence in performance here. In domestic stocks, the U.S. economy is not in the depths of recession anymore, but it's really not growing all that strongly either. Whereas in foreign markets, again, especially in Asia, you have a lot more strength, a lot more fundamental earnings power. So I think you're going to see this divergence where U.S. stocks may go up, but not by much. And at the same time, you're going to see much more dramatic gains in emerging markets where the growth is stronger, the fiscal outlook's better, and really the prospects going forward are brighter.
Nilus, do you agree?
Well, I think Mike raises a good point. You know, foreign economies do look stronger than the U.S. right now, and I'd note that I have a bunch of foreign dividend payers in my portfolio. You know, and again, I'm not looking for a barn-burning number from U.S. shares this year, but you know, I do think, relatively speaking, they will post a solid result. And you know, when you factor in dividend payments, I think that you're looking at decent total returns.
Bryan, what's your take?
Well, you know, I think you need to certainly watch the currency markets. If you recall last year, the first half of 2010, markets were really trading almost tick for tick with the euro as the situation there with the sovereign debt crisis was deteriorating. With that issue back in full focus for markets, I would continue to be very cautious with stocks, given what's going on in Europe. Certainly, if the eurozone can buy some more time with the crisis there, given the growth prospects in the U.S., stocks could do well. But there's certainly a risk not only to U.S. stocks but global stocks with a continued deterioration in Europe.
All right, let's hit interest rates now. I think that's going to be a big story coming in 2011. Mike, I know that you think they're going to be rising, obviously, as the year moves ahead here. Nilus, what is your take on interest rates?
Well, you know, I think we could see one more little dip in interest rates as the Fed kind of winds down its quantitative easing part two. But overall, I'm kind of in agreement with Mike in terms of I think the long-term picture for interest rates is they're going to rise from here. I mean, you know, obviously they've been at historic lows for many years now, and you know, as far as I'm concerned, the only way is up.
What about you, Bryan? And in that question, I also want to ask you about the effects that we may see with the Fed's policy and their interest rates on currencies and vice versa there.
Yeah, well, I think it all has to do with global demand here, really. Now, I happen to think we're in a long period of deleveraging here. You know, a global credit boom that took a decade to build is likely taking a decade to delever. And, you know, given that backdrop, I think we're in for a long period of low growth and low inflation. So, you know, I think rates in general will be range bound. I think we could see sort of maybe 2.5% to rather 4% type of range on the U.S. 10-year and a lot of volatility in between.
Bryan, I want to ask you about that. I mean, even if we do have low growth and low inflation, we've already seen that in economies like Greece and Portugal. Their economies are terrible, yet interest rates are still going up. Isn't there a risk that something like that might happen in the developed world?
Yeah, no doubt about it. I mean, there's certainly a risk premium already being priced into interest rate markets right now for the sovereign debt risk around the world. I think the question is, you know, what is that risk premium? You know, perhaps it does elevate that range. You know, maybe we see 3 to 4.5% in the 10-year, as opposed to 2.5 to 4. You know, it's a question of how do you price that risk? And you know, as I said, I think there will be a lot of volatility in all global markets, including interest rates. You know, if things get very ugly, how big does that risk premium get? You know, what are your thoughts, Mike?
Sure. I think that you really do have a risk that what's happened in Europe with Spain and Portugal and Ireland and so on, they're almost the equivalent here of what's going on in California or Illinois. And with the federal government bailing the states out, essentially, or likely to bail them out, that's going to lead to upward pressure on interest rates and downward pressure on bond prices, regardless of the backdrop in growth and inflation.
Bryan, we obviously were talking about the euro. We know where you think the euro is going to be going. It's going to be a pretty rough year in 2011 for the euro. What we didn't hit was the British pound. Do you think it's going to track lower along with the euro?
Yeah, I think you have to be very careful with any exposure to the pound. Certainly, if you're in Europe, you definitely prefer to own pounds or Swiss francs relative to the euro right now. And we've seen a lot of those sort of cross-border flows to neighboring currencies. But in general, if we do see the euro continue to track lower and potentially even go into an elevated crisis mode there, without question, it's going to drag the British pound down with it, and it's going to really turn the focus over to the UK and the debt and deficit problems they have there. So I think you have to be careful there. And again, if Europe can prove to buy some more time, you certainly like the pound over the euro. But I do think the forces of the downward pressure on Europe will prove to be a burden for the pound here as well.
Nilus, one of your favorite stocks has been National Grid Utility. That, of course, is a British stock. Are you more bullish on the pound than Brian is?
I'd have to say I am. I mean, Brian's raises a good point that the euro and the pound may trade down together, but fundamentally speaking, the pound is much stronger than the euro. So I think over the long term, those fundamentals are going to win out. But again, the other point I'd make is that National Grid Utility, my recommendation is not solely on currency translations. In fact, that's not even the primary reason that I'm recommending the company, but rather, my subscribers have benefited so far from favorable translations, and I think that over the long term, they're going to continue to do so.
Okay, let's do big picture time now here, gentlemen. Let's take all of the stories and trends that we've seen from 2010 and 2011. Let's bundle it all together, and how is it going to affect these three markets in the year ahead? Mike?
I guess I'll start with bonds. I think that we are going to see upward pressure on interest rates, meaning rising rates, falling bond prices. I think the impact will be particularly acute in the municipal market. Again, the threats that we're having to state and local budgets, the inability of tax revenue to cover expenses and pension promises, that's leading to not just rising muni yields as a result of the Treasury increase, but also additionally more credit risk being priced into our version of Portugal and Spain, which would be something like Illinois or California. So I think we are going to be dealing with a rising interest rate issue. There may be places to pick and choose, but broadly speaking, I'd want to stick with short-term bonds. I'd want to stick with maybe a few emerging market plays here and there and avoid municipals.
Brian?
Well, you certainly have to pay attention to what's going on in Europe. This whole thing is accelerated just coming into the last month of 2010 and going into 2011. So you have to watch that situation very closely. Also in China, if we get a slowdown in China, similar to what we've seen in Malaysia and Thailand, that could be a huge risk to global economic growth. So something to watch. Also with the protectionist pressures there, another major risk. And then you have the influence of North Korea into the last quarter of last year, which could pose a big threat to global stability and political stability, especially given the situation that it puts China to sort of make a call on where it stands in the global community. So these are all, big picture risks, I think, that you have to pay attention to, regardless of, you're getting maybe some steady upward movement in stocks that can easily be derailed by one of these major trading themes that I expect, will continue to dominate 2011.
And Nilus?
Well, I think Brian and Mike both did a very good job of outlining the risks going forward, and certainly there are a bunch of them. But I'd like to shift a little bit more to the opportunities. I mean, one of the big stories in my neck of the woods is all the companies sitting on large corporate piles of cash, and I think that that's going to provide a lot of good, solid dividends going into the new year. And I think also these are defensive kind of companies, the kind of companies that can thrive even if one or more of the risks we just talked about manifest themselves. So I do think while there are a lot of dangers out there, there are also going to be plenty of solid opportunities for savvy investors in the new year.
Okay, gentlemen, thank you all for your time.
Thank you,
Thanks,
Jamie.
Jamie.
Thank you.
If you have a question for any of this week's guests or a suggestion for a topic you'd like us to cover, just email us at weissmoneynetwork@weissinc.com. Coming up next week, we'll continue our postmortem of 2010 with a look at some of the year's biggest winners, the international and commodities markets. Sean Broderick, Tony Sagami, and Rudy Martin will join us for that. For Money and Markets, I'm Jamie Holmes, and now, here's Martin Weiss.
As you know, I don't tell our experts what to recommend, let alone what to think or say. So disagreement among us is always possible. But this is a time when we have broad agreement on two major themes. The first theme is all about troubles in the United States and Western Europe. We know that the United States government is on the wrong path with gigantic deficits and money printing. We know that despite the new tax deal, the U.S. economy still faces major headwinds, chronic high unemployment, big cutbacks by local and state governments, huge borrowing needs which are driving up interest rates, and anemic growth. We know that Western Europe has even greater troubles, Greece, Ireland, and now Portugal and Spain. Yes, Washington and other governments have the power to pour money into the economy, but they do not have the power to tell global investors where to put that money, which leads me to the second major theme, and that is that all the money has to go somewhere, and it is naturally flowing to those countries with the smallest deficits, the lowest unemployment, and the most vibrant growth. To sum up, we have big troubles in the U.S., bigger troubles in Western Europe, an outpouring of government money that is being diverted to areas that do not suffer from all these troubles. So for you, the action should be obvious. Reduce your exposure and your risk in traditional stocks and bonds here in the U.S. and shift, with proper moderation and caution, of course, to alternatives that are continuing to grow in this environment. Gold and silver, emerging markets, the strongest foreign currencies. This is Martin Weiss with Money and Markets TV.